In this video, I'm going to be explaining the 4 red flags that you want to avoid within the Forex industry. Now, over the last 10 years that I've been involved within this industry, it has absolutely accelerated and blown up, especially with prop accounts, funded accounts, you name it, and all these lifestyle gurus that we have seen on YouTube. So I want to discuss, if you are getting started within the Forex market, these are my 4 main things that you want to avoid to have the best chance of success. So let's get started with number 1. If you see a Forex influencer that is doing this with money, by the way, this is real money. If you see them in their videos doing this, and completely being a lifestyle guru, you can make this money if you just follow these tips. You can do all of this, you know. There is far too many people that are showing cash. Now let's just remember, the reason why we are trading Forex is because it's online. It is easy to actually trade it online virtually. You do not need to have anything to do with cash. Usually this is one of the biggest red flags that we have seen, is for some reason a lot of Forex influencers out there look like Post Malone. No hate against Post Malone these days, but yeah, it seems like we have got a lot of lifestyle gurus out there that are selling the dream by flashing cash, flashing Rolexes. And the truth of the matter is, if you are very successful within this industry, you don't need to do that because you are accredited. You don't need to be flashing around lots of money. So if you are seeing people with cash like this, then just get rid of it, because we do not need those individuals to be teaching you within Forex.
Guys, come and join our $100,000 free trading competition. That's right, you get to put your skill set in the Forex markets to test over a 2-week period, and the winners are gonna walk away with $100,000 cash prize pool. That's right, it's really that simple. There is no cost. Click the link, get started, and I'll see you in the challenge.
Number 2, when you get started in the markets, you want to avoid trading signals. Now, trading signals is marketed all over the world, and it's not something that you want to get involved with. When you start trading, it's all about making sure that you start on the right foot. Start with free courses, free education. That is one of the best places to start. But whatever you do, do not sign up to someone's trade signals. The main reason for that is because you don't know too much about that trader. Most importantly, you want to make sure that your education in placing the trades is there. You understand the core concepts of things like risk management. Placing those trades in just following someone else, regardless, not taking into account risk management, is completely pointless to the whole aspect of trying to make a profit from the markets, because you're just copying someone. You don't understand the risks behind it. You don't really understand why it's happening. So what's the point in doing it? You need to make sure that you fully understand your actions that you're doing within the markets. And most times these signal providers are actually just dossers on the internet with no actual facts or figures behind them or accreditation. It's usually a 20-year-old that's doing absolutely nothing other than providing signals. So make sure that you understand what you're doing in your background of knowledge before you ever even think of copying someone. And if you can, avoid it altogether. It's not a good way to start, and it will probably be the first thing that puts you off of trading correctly in the future, because you'll be picking up their bad habits. You'll probably be losing money that you can't afford to lose, and ultimately you're blaming that person for their results. However, it's you placing the trades. You need to take responsibility of that. And ultimately you want to take ownership of that. So avoid signals. Signals is only going to cause you more losses in the market, more pain in the market, and overall you're not going to learn anything credible from taking signals. So having a core educational background yourself and improving on your own knowledge on a day-to-day basis, and don't risk any money that you can't afford to lose. You need to be practicing on a demo and making sure that you increase your skill set before you even think about risking real money. Point 3, selling the get-rich-quick scheme. Now, if anybody is approaching you to trade, then you've got an issue, okay? Most of all, you shouldn't be getting DMs or anything like that from experts, yeah? These experts are so busy that they won't have time to be doing outreach to say, would you like to follow me? Would you like to learn from me? they're not going to be doing that. And for certain, I definitely do not have the time in my day to be outreaching to anybody to come and learn from me. It's not something that I want to entertain or something that I want to do. So that should be a red flag. The second part about this is, if these individuals are trying to tell you that this is easy with just 15 minutes, 30 minutes a day, or we can be sat on a beach with a pina colada trade in the markets, these are all things that you want to avoid. I can tell you now from someone who's sat here for 10 plus years trading the markets, trading, when you get professional at it, it's very boring, it's long hours, and it's, again, something that is very stressful in the long run if you're doing this as a sole career. So I don't want you to sit there and go, this is gonna be super easy to do with just 30 minutes of my day, I can become rich. So we want to avoid the get rich quick schemes. These aren't realistic. There is no guarantee of making £1,000 a day by copying someone's signals, by doing anything, by following this strategy, you're guaranteed £1,000 a day. No. From someone that's been doing this for over 10 plus years, you can still have negative months within the market. And that is something that you want to remember. You're not going to get wins, wins, wins all the time. Losses are part of the journey, and you will have losing months. So you've got to bear that in mind. Trading Forex takes skill, patience, and a large amount of time dedicated to research. As long as you understand that, you're going to get started on the right foot. My fourth point is overestimating the benefits of leverage. Now, when you get started, you want to use low leverage. And actually, from a professional perspective, you probably want to maintain using low leverage throughout your entire trading career. Leverage is a double-bladed sword. So when we think about this, it has benefits, yes. That means that you can make more money from having smaller capital by maximizing that leverage as much as you can. And on the other side, that means that your losses can be huge as well. You don't want to be doing this where you're risking your account for a large gain, or on the flip side, potentially getting a large loss. When you get started in trading, it's very clear that you want to make sure that you're taking incremental small risks trade by trade. You know, if you're getting started, even risking something like £10 or $10 per trade to get started, get the feel, get the understanding of how that feels from an emotional perspective within the markets. You're not going to make a large amount of money very quickly without having the education or the practice within the markets. So making sure that your leverage is as low as it is when you get started is absolutely fundamental to your long-term success. It all begins with protecting capital first before making these large gains within the markets. So if you're going to an educational company or you're going to a brokerage and they're trying to push for large leverage, be very conscious that there must be a twist or a reason for why this benefits them for you having large leverage. And usually, for example, especially for those that are on funded accounts, I won't name any platforms out there, but the reason why they have large leverage is so that you can hit the max drawdown level of that 5% or 10% that they have, which is very easy when you have large leverage. This will mean that your account gets closed and you then, guess what, have to pay again to get started. So you want to avoid these funded accounts that have high leverage because they're expecting you to blow it and then, guess what, reset and pay again. So overall, with leverage, don't forget, yes, you can amplify your gains, but you can also amplify your losses. Leverage is something that you use at professional level, usually within hedge funds or leverage on ETFs, for example, that can see a large potential gain, but with a good amount of education behind them. This is not something that you want to try using as a beginner. So let's just recap. Number one, avoid lifestyle gurus that are flapping around a large amount of cash. Number two, avoid signal services. It's much more important to start your education the right way, and that starts with you. Number three, avoid get-rich-quick schemes. It is not easy. This is a craft. It takes skill, it takes practice, and it takes time. Number four, avoid high leverage. High leverage is only going to damage you, especially if you're a beginner in trading the markets. So guys, I hope you've enjoyed my red flags video. There's so many risks out there that you need to stay cautious of. If you've enjoyed this video, make sure you hit that like and subscribe button. And most importantly, if you want to get started the right way, then check out the link in the description for my accredited training courses. They are Ofqual regulated and you can get a level 5 or a level 7 diploma within financial trading. Best of luck guys, and I'll see you in the next video.